Oh, you want me to talk? Well, good evening. Thank you. And we're excited to be here to be in conversation with you. We're going to talk a little bit about the Tax Act and some things that we can do. Happy to take questions as we go. So if there's something on your mind, feel free to raise it. Someone in the room likely will be thinking the same thing and may have some insights to share with you. I did mention to Sasha beforehand that, she and I have been blessed to have been invited to present to this group numerous times. And in addition to that, I've been invited to speak to this group numerous times, probably 8-10 times in total over the past 15, 20 years. Very exciting. So I said to Sasha, it must be a sign that, they like us. And she said, Mark, let me tell you a story. There was an American violinist who was really, really good. And he was invited to go to Salzburg, Austria, to play Beethoven's violin concerto to probably the most erudite crowd in the world. He was very excited. And so he went, and it came time for his solo. And he performed it to the best of his abilities. No sooner did he hit the last note when the crowd as one stood up and shouted, again, again, again. So he played it again. Once again, as soon as he finished, the crowd rose to their feet. Again, again, they shouted. He was just over the top of the excitement. So he played it a third time. Whereupon the crowd clapped and moved on. Afterwards, he goes to the conductor and he said, can you believe it? This crowd asked me to play that piece 3 times. It must have been just, I can't believe it. And the conductor said, well, hang on one second. I think maybe you're misunderstanding. They didn't want to hear it again because you did so well. They wanted to make sure you played it until you got it right. Here, hoping that maybe I'll get it right. Do we have a clicker? We do. Yeah. Well, we're not really in slide mode. Okay. So we're going to talk a little bit about, look at that, that's enough. We're going to talk about some of the chaos that's going on. We talk about real estate. Chris was saying it's crazy out there. It's crazy in D.C. also, right? I mean, we're not even sure Congress knows what Congress wants. But let's explore some of the things that are being discussed. We now have a shot over the bow from the House Ways and Means Committee. We've yet to hear from the Senate. So we want to walk through a lot of these proposals, and so we can be aware of how to talk to our clients and with our clients. And so strategic planning for another year of change. Look, clients, English is not what they hear when we talk about these things, right? It is incomprehensible to them. So, you're going to put it in slide mode. Slide mode. Slide mode. There we go. I got it. There we go. So what about clients? They might go through a wide range of reactions, right? The uncertainty, the fear can lead them to a lot of anxiety and may lead to a lot of very busy year ends for us. And so, talking with Mark Brown and some others, are already just overwhelmed with the work that's coming out for clients trying to prepare for what changes might be coming. This, from Marissa Dungy, she allowed me to share, is just an example of where some of these changes are emanating. Where are they coming from? All over the place. They sound like they're having more fun. The House Ways and Means Committee proposal is what we want to focus on. The Build Back Better Act that we've seen proposed. And so we're going to go through a number of those changes, starting with some of the income tax things. Sasha?
Everybody hear me okay? Awesome. Okay, we're going to be handing it back and forth. We didn't practice that part. Anyway, we all know that the proposal increases the top tax rate to 39.6%. What we wanted to highlight here are the additional income tax applied on top of 39.6, which I think are going to impact our clients even greater, even though 2.6 is great. We've been there before. The first thing is the expansion of the net investment income tax, 3.8%, And then the bigger one, which is a 3% surcharge, which is going to be on high income earners. You know, over 5 million, that's a great number, but where I think the biggest impact is for trust and estate. This is going to impact all those trusts that have earned income over $100,000. It's a lot of trust. And if for any reason the grantor trust business gets through, we're going to have a lot of non-grantor trusts that will be paying this surcharge. And together, it looks like 46.4%. And then if you're in another state instead of Florida, it'll be very high, low 60s, high 50s. So we're really looking at much higher income tax.
Yeah, I'll make a comment. So, yeah, for example, also with the trust, that expansion of the section 1411 tax at 3.8%. Right, historically, there was a carve out if you're in an active trade or business. That carve out is proposed to be eliminated. So it would apply to all business receipts, assuming that you're past the top bracket trigger, which for trust is going to be slightly over $13,000. So we very quickly get into the 39.6 plus 3.8 plus 3 for trust. And that can be a big, big difference.
Right, so capital gains, this is also going up. I really liked it when it was 15%, and it was 20%. Now we're looking at 25%. It's almost like we're rolling back the clock to 1993 when it was 28%. If you add the NIT on top of this, we're back to 28%. So we've been there before as well, and it looks like we might be going back there. Another negative is it will be effective for as of September 13th. There's not a whole lot we can do at this moment. We'll have to see.
Yeah, I'll comment. I don't need the microphone. This is an issue that our clients need to think about. And so we really plan to spend a lot of time later in tonight's presentation digging in on some capital gains planning techniques that we, might want to put in play.
My favorite slide. Thanks to Richie, I'm more of a transfer tax human than an income tax human. So this is more my passion. So one of the things that looks like will happen is the acceleration of the sunset of the estate gift and GST exemptions. This is actually an easy one to think about. If you're in front of Congress, you're trying to raise revenues. It's going to sunset anyway. So it's like, this is a pretty easy one to put through. I think if anything gets done, I think this is in there. If it didn't get done right, it'd be 12.6 million, 2022. This is going to roll back to 5 million plus inflation, which looks like it's 6 million 30. So your clients definitely should be using this. If they're not, I think all the trust and estate attorneys in this room will be very, very busy year end. One of the neat ones here is the annual exclusion is going to go up to 16,000. It's inflation adjusted, as we all know. But it's inflation adjusted down to the nearest lowest thousand. So we've actually been in the 15,000s for a while. We've just tripped over 16,000. So now we're rolling it back down to nearest thousand, which happens to be 16,000. I really like the annual exclusion. It's always fun because people always think it's about 10,000. Just a fun one.
And that's not a proposed change in the act. That's what's going to happen. That's already in the law. When we talk about 20. So section 2032 cap A is looking to be adjusted. This would be one of the very few taxpayer-friendly changes in the Build Back Better Act. So 2032A is a valuation rule. Recall that for estate tax purposes, real estate needs to be valued at its highest and best use, not its actual use, with two exceptions. Those exceptions are for real estate used in a farming activity or in a small family-owned business. That real estate can be valued at its actual use unless the actual use under the current law is more than $750,000 lower than the highest and best use index for inflation, approximately 1.16 million. What that means is this: if your use in the farm is $20 million of value, and when you die, the highest and best use is $40 million, for estate tax purposes, it would be 40 million minus 1.16 million, 38 and change. Under the BBBA, check out this number. They would replace 750 with $11,700,000. Well, that's a convenient number. You wonder where they got that from. So in that instance, the 40 would be reduced to 28,300,000. Very taxpayer friendly for the small business and farms in the U.S. Sasha?
Promise it was get warmer in here. shaking my jacket. So cold. Anyway, all the people are in here. Need to get warmer now.
You can have them.
So another thing is we're looking at is the elimination of valuation discounts for non-trade or business assets. Been here before, 2704. This is for the portfolio, limited partnerships, and your LLCs. And feel really, really cold. So, thank you.
Fix Mark.
So this is back again. So same thing, we need, the moral of the story here is we need to be doing planning right now.
So it actually looks like that in a typical situation where you have a mixed basket of assets, you could end up having to get 3 valuation. Are there any valuation folks in here? No, not tonight. So for example, the discounts would still be available for an interest in active trader business, but not in a passive. So your client set up a family limited partnership that only has passive investments in it, then those interests will not be subject to discount. It would just be a prorated value of the underlying assets. If, on the other hand, that partnership owned both non-passive, passive investments, and then maybe a business interest that was active, you would then have to have the passive assets value, the non-passive, and the combined value. So this could really be complex for individuals. We've known that ever since 2704 was adopted, that it has failed because of state legislation. And so Congress has been trying to fix this since 1993. We know that in 2016, we had proposed regulations that would have fixed and eliminated discounts. That obviously got pulled by the Trump administration. Here it's back. So there are some other things that are going on. The next 2 slides, we're going to talk about some of the retirement plan proposals. We know that there's been an emphasis now for several years and reinforcing the notion that deferred income accounts are not wealth gathering, wealth accumulation vehicles. They're designed to provide individuals an opportunity to set aside funds to be used in their retirement. And Congress is upset that too many have been using it. We saw some of the provisions in the Secure Act that have gone after this. And now what's being proposed here are several things. First, elimination of backdoor Roth. Backdoor Roth conversions are very popular. They're so popular that at my firm, you can actually go onto the HR site on the internet and just check a box, click one click of the mouse, and it will do a backdoor conversion for you. Those would be eliminated for all taxpayers. Remember that most of the BBVA is focused on high net and high earners, 400,000 and up. This one would apply to everybody starting January 1st of 2022. A second proposal would not take effect until 10 years later, 2032. That's not a typo. In 2032, high income earners would not be able to do a Roth conversion at all. Remember, originally they couldn't, then there was an expansion of that. Now everyone can convert. Come on. I'm glad you don't know how to wear a mask jacket. And so that would be eliminated come 2032, and there would be no Roth conversions available. Some other changes. This would affect many of our clients. Large accounts. And when we look to measure large accounts, we're looking not just at IRAs, but other deferred income accounts, defined plans. Several rules here. First, if the combined value of all of those accounts is 10 million or more, no contributions could be made that year. Second, if the combined value is $10 million or more, there will be an enhancement to the RMD equal to 50% of the excess over 10 million. So if there's 12 million in those accounts total, you have to take a $1 million RMD distribution in what will be a high income tax rate year, most likely. The third change, if the combined values are $20 million or up, 100% of the excess over 20 million must be distributed as RMD and taxed. And that doesn't excuse the 50% rule. So if you had $22 million in the combined value, you'd have to take the 2 million over 20 and 50% or 5 of the difference between 10 and 20. $7 million R&D. And by the way, if we happen to have a spike in the markets on December 30th so that the values trip over those on the 31st and then the legs get cut out on the 1st, that's just too bad. Oh, so Sasha, I'm going to turn this one over to you. 2 new tax code provisions are inserted in the BBVA, 2901 and 1062, and this one has generated a lot of hubbub. Why don't you lead us through it?
A lot of hubbub and not a whole lot of money raised. It looks like this only raises about $8 billion. It doesn't do a whole lot, so hopefully it doesn't happen because it's going to be really complicated and not very helpful.
Well, let me interject, because that's a really good point. They remember that this is through budget reconciliation. So there's $3.5 million worth of provisions that they're looking for pay-fors. And so all of these tax revenues are scored by the CBO to determine how much they will pay for. This grantor trust provision, remember, they need 3.5 trillion at least. This provision, broad, wide sweeping, would affect all of us dramatically, only would raise 8 billion. It's hardly worth it. But here it is.
You upset?
Yeah.
Many of you already know a lot of these, but like grantor trust would be included in the gross estate. You understand an exchange, the trust and an owner would actually be treated as between a third party, basically meaning the interest earned would be subject to income tax. One of the best things we have. Don't want that to happen. Distribution from a grantor trust would be a taxable gift. And termination of grantor trust status would be a taxable gift. One of the questions I have is, do you turn it off now? Do you turn it off later? Do you turn it off after enactment? It'll be a taxable gift. So what? But you don't want to have to return it back on. It's harder. So what do you do? It's almost like a chicken and egg issue.
Well, the proposed effective date of this provision would be January 1st. So I know, for example, we have a government relations group at my firm working with Congress, and their prediction is if anything gets passed, it gets passed right around Thanksgiving. So it gets through the reconciliation process. So that might give clients 4 or 5 weeks to learn about this, make appointments with you, and then address things, which isn't a whole lot of time, which is why you want to sort of set the stage with them now. Now, the other thing is there's a footnote for technical corrections suggesting that there may be a need to change the effective provision for the grantor trust rules such that although you can have a grandfather trust, any dealings with that trust subsequent to enactment would still fall under these new rules. So for example, in 2020, your client sets a 2-year GRAT. In 2022, if this were effective 1/1, when the second payment under that GRAT comes out, that would be a deemed gift. Or if your client wanted to immunize your GRAT through a substitution, that would be a taxable exchange. Because this provision also suggests that any dealings between the grantor and the grantor trust will be treated as though there was not grantor trust status. So a swap with an irrevocable grantor trust will now be a sale or exchange for capital gains purposes. Yeah, isn't that fun?
One good point, though, you do get credit for prior gift tax paid. Yay.
Oh, sure. So, the silence is deafening on some provisions in the BBVA. Some things we know the Biden administration was really seeking. Now, many provisions of the Build Back Better Act actually come right out of Bernie Sanders for the 99.5% Act, which was similar to his for the 99.8% Act, something he's been introducing now for 15 straight years. But it's beginning to see the light of day in the BBVA, but some things weren't there. And here's a list of some of them. Sasha, which ones stand out to you?
Ones that aren't there that stand out to me would be the capital gains at death, the elimination of the basis adjustment. I think we're all worried about those two a lot. We talked about them a lot, and they're not in there. There's no increase in the transfer tax amount. And that's another big one. And then the GST exemption duration limit is also not in there. The neat thing is we're looking at a trust glitch bill in Florida to increase. And we have 360 years in Florida, but our glitch bill would actually make our rule against perpetuity period 1,000 years. Not sure of the purpose of 360 and 1,000. I'd like to see a 1,000-year-old trust. I don't think I'll live that long, so I'm mortal, but that's what's going to be in the bill. So Florida's going the other way with it.
Lots I want to say to your comment, I'm mortal, but I won't, because we came in the same car. So, by the way, for those of you who don't know, Sasha and I are married. So, just so you well, thank you, man. So, one of the other things that's not in there, right, is salt cap. We thought for sure, right, that we would see a raising of that cap or an elimination of it. Another thing, FICA tax. Richie has a lot of business clients who have a lot of deferred income or bonuses or other payouts. So one of the things that was proposed by the Biden administration in the Green Book was this donut where they would reinstate the 12.4% FICA tax at $400,000 without an upper limit. The code provisions that deal with FICA tax permit the employer to elect the timing of taxation for FICA purposes of deferred compensation. One of the things I know I talked to our company about was to take a look at this and say, well, right now you stop paying FICA around 162, something like that. So if you have high paid executives who get big bonuses or deferred compensation, they're already past that. And you can run their $2 million, $3 million, $10 million bonus through the tax system right now for FICA purposes, not income tax. It'll be treated under the current rules and then grandfathered. And many of those are invested. So if that $10 million bonus is invested and gets paid out in 3 years when it's worth $12 million, there'll be no FICA tax on that. You're saving 12.4% on the amount over $400,000. So pay attention, because what we do know is this is a tennis match and the Senate has yet to hit the ball. So we expect some of these things to see the light of day in the Senate. So one of the first times I ever saw Sasha speak, she was co-presenting with Carol Cantrell at an ABA meeting in Philadelphia, Pennsylvania, maybe 15 years ago. And you were talking about carried interest and vertical slice planning and all that great stuff. So why don't you talk to us about carried interest?
Well, the Biden administration really wanted to take a bazooka at this, and honestly, they shot a marshmallow. So, they wanted to make all carried interest treated as ordinary income, but all they do is actually just extend the holding period from 3 years to 5 years, and you still get the benefit of the capital gains treatment. It's really the biggest takeaway here. Nothing really changes except for the holding period. It's basically as relevant now as it was back then.
Okay, all right. Yeah. So one of the planning strategies that I'm having clients do are shelf grabs, something I've written and spoken on, including to this group before. Because if we do see, say, something from the Senate that looks like the Biden administration proposal for a 25% gift on grads, so there's no more than, no shorter than 10-year term, things of that nature, it might be a great idea to have clients create an inventory of grads under the current rules, fund them. So if they're doing a 2-year rolling grad program, maybe right now they also establish 2021, 4, 6, 8, and 10-year grads. Fund them with fixed income or low volatile assets, then take them and put them on the shelf. Right? You've activated them, you've triggered them under the current law. So in 2 years, when the 2021 2-year grad is terminated, if the 75-20 rate is up or the law has changed related to grads, you can go to your inventory, take out the 2021 4-year grad, which now has 2 years left on it. And if we don't get the 2901 grantor trust provision, do a swap, and now you have a 2-year grant under today's 75-20 rate, which, by the way, hustle up. It's going up 40% next month. It's currently 1%. It'll be 1.4 come November 1st. Salt cap workaround. We don't worry much about this for Florida residents because we don't have state income tax. But the IRS has approved a workaround through the use of a pass-through entity, and these states have adopted it. The way this works is if the pass-through entity pays the tax, the service will allow the entity to fully offset income by the tax paid. Therefore, the owners will get the benefit of the full deduction and thus work around the $10,000 limit. Sasha, use it or lose it.
Talked about this a little earlier, under the transfer tax space here, but it's use it or lose it. So we have $11.7 million right now for our clients to use. It's gonna go back potentially to $6,030,000. That's $5 million plus inflation. So we really gotta be using these exemptions. If a client can't give all of it away, pick a spouse and use the whole thing, only using, gift splitting won't work because unless you get over $6,030,000, you're not saving anything. So every dollar over $6,030,000 to me is a win. You save 40% on every dollar over that. So you gotta get over that amount. And if a client for some reason can't use it, just try to maybe one spouse and not the other spouse. Gift splitting won't work.
Is that it?
No. And for the other side of it, for the wealthier clients, and they've already used their 11.7, as many have, this is the largest we've seen, maybe the largest we'll see for a while. Think about being creative and broadening your thinking. Can you go up a generation? Can you go down a generation? Look at parents, look at kids. Do you have a non-exempt trust for a child? Can they distribute all the assets out and let them fund a trust using their exemption? Just look around and try to use everybody's exemption if you can. Think about loans as well. The interest rate is so low. Loan the money up and let a parent use his exemption or her exemption.
Oh, it's a poltergeist moment. There's a question in the back. Michael.
Obviously, this all work around. All the states have been adopting the rules. It's all different. The Congress is still talking about removing what was added like this. So I'm interested in heard anything about that negotiation regarding that one issue. I mean, states are all implementing work around. So it conflicts with the federal unwinding. So thoughts on that?
Yeah, so thoughts on, given the fact that Treasury has now approved state techniques for the workaround on the SALT cap limitation, knowing that many of the state Democratic states are actually also asking for the lifting, the raising of that cap to a higher amount. Isn't kind of surprising it wasn't in the Build Back Better Act? We know the Biden administration approves this as well. What I fully expect, and I can tell you that in all my years of predicting legislation, I've never been right, but I fully expect that the Senate bill will have a provision dealing with this. As Michael points out, it's chaos there because you have states with different schemes, they're adopting different schemes. And so it's just inconsistent, which leaves a lot to be desired for our clients as taxpayers. So thank you, Michael. Also, to be worried about is the thing we were told we don't have to be worried about because maybe clawback is going to be clawed back. How and why did this happen? Remember, clawback is that issue that we were worried about until we got some regulations that told us not to worry about them 2 years ago. The thing we were worried about was this. Client uses an exemption that is higher than the amount of the exemption that exists on the date of death. So let's say makes a gift this year of $11,700,000. Let's say they die in a year when the exemption is $6,030,000. The question becomes, does the estate need to pull back in, claw back that difference between the 6 and the 11? And so we got relief from the Treasury saying, no, that is not the case. The Treasury, of course, always has the ability to have anti-abuse rules. And so we knew that they had the ability to put in place rules dealing in a situation where there were abusive transactions. So then in September of this year, in the Treasury Priority Guidance Plan, there's some ambiguous language in there that suggests that maybe what needs to be done is a more expanded version of the anti-abuse legislation in this area to reinstate clawback above and beyond that evil that they're concerned about. And I think that that's not so much for our clients to worry about. I'm not counseling clients that they should be worried about this. And here's why. Anybody in here from New York State and we're a member of the Bar Association, don't raise your hand because I'm going to pick on you. You guys did us a disservice. So when the comment period came out for the proposed regulations dealing with clawback, the New York State Bar Association went to Treasury and said, what if we did intentionally a transaction that would be subject to the string rule and be included in the estate? For example, we know we can't do grant or retained income trust, GRIT. Why not? 2701 says if you do a GRIT, then those assets will be included in your estate. But what the Bar Association indicated was, well, the way the mechanics work is, if you fund a GRIT today, you have to use your gift tax exemption. And the way the 706 rules apply is that if you have a transaction that is pulled back into your estate, you get back the exemption you allocated to it. So couldn't we, Treasury, intentionally defect a transaction, apply our 11.7 to it, knowing it's coming back in our estate, but when the exemption's lower, I'm still getting all the 11.7 back. And that's what they're going after here. Oh. So capital gains planning, I get the easy stuff. Sasha gets the sophisticated fun stuff. Capital gains planning, I just want to refer to a couple of deferral techniques because we know we can't sell assets now under the BBVA and avoid the higher capital gains tax rate. So what can we do? Well, we can do deferrals. Oh, you can do an exchange fund. You can do an installment sale. You can do some other things. I want to talk for a second about QOZs because, well, first let me just mention this, Section 1035 for Marshall and Mac and others, right? That's the ability to exchange tax-free insurance policies. That's been expanded now to include long-term care contracts, if you have value in those, so that too can be done. I know we're often accumulating massive amounts in there. If they qualify, there we go. But the clock is ticking on qualified opportunity zone treatment. And here's what I want to just remind us about. Starting in 2017, we know that we get capital gain deferral for an investment in a QOZ, a zone, qualified opportunity zone, qualified opportunity zone business, or qualified opportunity zone business property. And the way that works is if your client invests the capital gain in one of these qualified investments within 180 days, they do not have to pay capital gains until the earlier of an inclusion event or December 31st, 2026. So client sells an asset for 10 million, had a basis of 9, $1 million capital gain. Need only invest 1 million. Doesn't have to be that million, it can be any million, but doesn't have to, like many of these others, you have to reinvest the whole thing. Here, just the gain. If that's reinvested, we don't pay capital gains on it. If you hold the investment for 5 years, you get a 10% augmentation to your basis. So say it's a $1 million gain and you put cash in that has no basis. You hold the investment for 5 years, you're going to get a $100,000 free basis augmentation. If you retain the investment for 7 years, you get an additional 5% augmentation. Now you're at $150,000 in free basis. If you hold on to that investment for 10 years and sell it before 2042, you actually don't have to pay gains on the appreciation. The $1 million goes into the investment, it's held for more than 10 years, it's sold for $1.5 million. The $500,000 difference is free for income taxes, and you get a $150,000 basis adjustment. But we can do math. If your client is looking now to do something and they'd like to get the 10% basis augmentation, they have to make the investment before the end of the year. I wouldn't let the tax tail wag the investment dog, so to speak, because you need to make sure it's a quality investment. right? I mean, Chris, maybe you can help us find a good real estate investment property that is QOZ. Oh, okay. All right. So we've had two sets of proposed and one set of final regulations that tell us that inclusion events are things like sales and transfers by gift, but death is not. So if I die and my QOZ investment goes to Sasha, it will tack and she gets to hold on to it. Alternatively, if on my deathbed, before I die, I make a gift of it to her, that will cause an inclusion event. More than enough on that. Let's skip through these. So one of my favorite aphorisms, from the sublime to the ridiculous is but a single step. I always attributed that to Bonaparte. However, it turns out he in fact was quoting Thomas Paine. So Sasha, why don't you help us with the Paine? Oh, why did that slide get here?
Right.
Start with this.
All right, one of my favorite planning techniques is qualified small business stock. So many things we do are deferral techniques. This is actually an exclusion. You can actually exclude capital gains tax on qualified small business stock. So it's absolutely just a fun one. It definitely gets my blood going. So what is qualified small business stock and what do you get to exclude? So what do you get to exclude is capital gains up to the greater of $10 million or 10 times basis. A lot of these are startup companies, so basis is nothing, but there's some basis in it. And you don't only just get to exclude the capital gains tax, which now could be 25%. You also, it's not subject to the net investment income tax either. So it's a huge saving. And then a lot of these are, California or New York and taxpayers. So larger for those guys. It needs to be a C Corp. And it only applies to the stock sale. It doesn't apply when you sell the assets in the company. How did this start? In 93, you started with a 50% exclusion. So you only got to exclude 50%. So like 93 seems to be the common theme throughout this talk. 93, 93, 93. And then it went in 2009 to 75%. And then in 2010, it was 100% exclusion. The House bill would actually repeal the expansions, bring this back to 50%. And if you have a client that's like, oh, I want to do the sale now, it's too late because again, it goes back to the September date. So any deal that wasn't struck pre-September 13th will be subject to the 50% exclusion, not 100%, which is a pretty big deal. It has to be a domestic C Corp, right? And many of the things, so it also can't be professional services like some of the other, for some reason, the lawyers and bankers, everything get excluded. So it can't be that kind of business. And
I always want to say something. So one of the limitations in qualifying as a qualified small business is that the company cannot have assets in excess of $50 million. Now, just like with the 2701, Sasha, I know, we do vertical slice planning. So if your client is looking to preserve treatment for QSBS, and the assets are getting beyond or close to your limit, you can do some vertical slice planning. There's also some interesting thing. I know Sasha has represented a number of Silicon Valley companies and does a lot of these, and you do this lacking, snacky, packing, whatever it is you do.
Lacking and stacking. One more thing for the stock, you have to hold for 5 years. So I think, the public policy behind this was they wanted to create some creativity in the United States. But if you invest in these companies, it's really risky, right? I mean, so many companies fail. So this is one way you may be willing to make an investment in a new company if you know that your gain, if you hold the stock for 5 years, will be, this won't be taxable. So this has really got a lot more inflow into these companies. I think some angels already were created. Some of that market buzz was created because of QSBS. Some of the money that flowed into the creative space was because of this provision. Anyways, public policy perspective, but packing and stacking is awesome, right? So you get $10 million. Well, guess what? I can give you 10, I can give you 20, I can give you 30, I can give you 40, I can give you 50, I can give you 60, I can give you 70, I can give you 80. How wealthy can you make your company? Every non-grantor trust, irrevocable trust, can actually qualify itself as its own taxpayer and get the $10 million exclusion. One of the requirements, though, is the grantor and the beneficiary cannot be distinct. There's a multiple trust rule that applies to this. And so the IRS says either the grantor can't be the same as a beneficiary, or it can't be for tax purposes. Their act has already said they're gonna assume it's for tax purposes. So writing a letter in the file saying it's not, probably won't work. So you do have to have a different grantor and beneficiary. So if you have 3 children, you got 3 trusts, you say, well, I'm married, doesn't work, husband and wife, or you just 1 grantor, so you don't get 6 in that case. But you can go to brothers and mothers and sisters and uncles. And one of the things I do is to expand it. You can actually create a limited power appointment during the lifetime of the trust. So the permissible appointee is not a beneficiary under the law, definitely not in Florida. So you can actually put that in case you need to. I got a client who didn't have kids yet, so we use a lot of other people, but his descendants, his descendants are going to be permissible beneficiaries of the limited power appointment. So it's another way to kind of get creative inside the document. These are great. They're really great. And I say to clients, look, you're going to pay the tax no matter what. So it's kind of heads you win, tails you tie. There's no rulings. Okay. All right, so the other plan technique is a flip NIMCRA, net income makeup, share remainder trust. So client funds a low basis asset into a partnership, right, and takes back the limited partnership units. And then he contributes the limited partnership units to the NIMCRA, right? Let's say the partnership holds a piece of land, right, the low basis asset worth $5 million. The partnership sells that low basis asset for $20 million, right? You invest the proceeds, right, starting to earn interest over time. It's kind of like a 401k on steroids, right? It's earning income on this 20 million. Tax free, why tax free? Well, there's no payment of capital gains as long as they're retained in the partnership. What does that mean? Well, the NIMCRA says that it pays the beneficiary the lesser of the unit trust amount or income. Well, the income is being retained in the partnership. It's not coming up to the NIMCRA. So it's being retained down here, earning free interest over and over and over, and income over and over again. Another neat thing is a client, let's say in 5 or 10 years, says, oh, I want $1 million out of this. Okay, so the partnership distributes $1 million up to the NIMCRA. The NIMCRA distributes out to the client that year, right? $1 million. Originally, right, the land, you had a $5 million piece of land, you sold for $20 million. You had $5 million of basis, and you have 75% of capital gain, right? So 25% of basis return and 75% of capital gain. The $1 million comes out, 25% return of basis, is 75% of capital gain. No matter how the partnership invests the assets, it retains its character. So it's an awesome technique, and Mark actually has an example that he actually used this once upon a time. Saved a lot of money for $1 billion client. Right?
Well, actually, the client was about to diversify a position that had a $1.1 billion unrealized capital gain. So we ran the math. We looked at prepaid forwards, we looked at collars, any financial derivative out there. And then we compared it to this technique using a 20-year flip NIM/CRUT within the FLP to own the asset. And I can tell you that this bumped all the financial stuff and made the clients a lot more wealth at the end of the time. Again, so they sell the 1.1 billion of gain. So there's, 1.5 billion total proceeds in the partnership that gets to reinvest the full amount, right? There's not that income tax or capital gains haircut where you're investing only the net. So for, in this case, 20 years, the entire 1.5 billion can be reinvested and grow, and no income tax paid until distributions begin 20 years down the road. Comment from the Peter County.
So this is also a no rulings list. The main thing the IRS is looking at is that the trustee and the general partner are not the same, right? Because there's control issues, as they're saying. You want to make sure when you're talking to your clients, always about control. They can't be both the trustee and the general partner.
This is a fun one. So and we've got 2 more, and Jackie inserted a final slide that has got the CE number. So you guys can leave when you want, but we can talk for as long as we want. You don't get that until we decide you get that, because I have the remote. So get out the phone book, let's read it. Filibuster. Cryptocurrency loss. You've heard me speak about cryptocurrency being property. Since 2014, the IRS has told us it's property, which is why that famous case out of Miami-Dade County where Mr. Espinoza was accused of money laundering, in which he used Bitcoin to buy stolen identities from the Russian mafia. And he was being prosecuted in Miami-Dade County. It's not a joke. By the way, it would be a good setup for him. However, the judge said, well, you can't be found guilty of money laundering when you launder using cryptocurrency, which we know is not money. We also know that cryptocurrency for the moment is not defined as a security. So what have some people done? They're beginning to do tax loss harvesting with cryptocurrency. We know that Ethereums and Bitcoins are very volatile. And we know that there's a code section out there called the washed sale rule that says if you, a taxpayer, sell an asset, sell a security, a stock or security at a loss, and you repurchase the same or substantially similar security within 30 days, you cannot take that loss. Well, guess what? Cryptocurrency is not a security. So what's being done? Every time it bounces down 5%, 6%, sell it and immediately rebuy it. Sell it, rebuy, sell, rebuy, sell, rebuy. And you're harvesting losses that can be used. Now, if you're in the process of doing this, pay attention. The SEC has announced that they intend to recharacterize cryptocurrency as a security, thus thwarting this strategy by the end of this year. May or may not happen, but pay attention. So there is one more deferral income tax planning technique that I am really excited about, and it's even better now thanks to the second Coronavirus Relief Act that came out at the end of 2020. So let's set the stage for Internal Revenue Code Section 7702 and the corridor and premium tests that are being used to determine whether a life insurance product is a qualified life insurance product. Why do we care? Well, if it's a qualified life insurance product, we don't have to pay income tax on the earnings inside the product. Right? That's the benefit of being qualified. So how do we test for that? Well, there are 3 tests that are in 7702, and they have been set with interest rate numbers, a 6%, 4%, and 4%. Well, at the end of 2020, there was a change to 7702 that reduced the interest rate factor for calendar year 2021 from 644 to 422. And starting in 2022, it will be a floating rate. So why do we care? Well, it helps for any permanent policy, but for those clients that are using private placement life insurance as an income tax strategy. So it matters a lot. Typically, when I want to buy insurance to make sure that Audrey gets through school, if somebody dies prematurely, I'm looking to get maximum death benefit with minimum premium. So I want a maximum death benefit with minimum premium. But for your clients that are looking to use this tax strategy of PPLI, you want minimum insurance and maximum cash. Why? You want to stuff as much as you can into this income tax deferral product. So what can harm the effectiveness of this technique? Expenses, right? You have to pay for insurance, and that's a cost. Look at the example from last year to this year. For a 50-year-old male, $10 million in premium required over $52 million of death benefit. Yet under the new test, only $32 million. What does that mean? That means there's $20 less million of coverage that needs to be paid for by the earnings inside the policy, which means there's more earnings that are retained inside the policy, which is to the benefit of the investor, your client. So this strategy is made better now than it's been before. It's clearly even better in a higher income tax rate environment. And I am going to co-broker all policies with Marshall Jones and Matt Lowry. Tonight only, especially, you get the real estate and one PPLI policy for free. Okay, are we done? The trick now is to turn insight into foresight. So with that, We thank you. I'll leave you, we don't need that quote. Any questions? And before I get to that last slide. Yes. Hi, Matt.
First of all, you should throw Anthony Pace in the Steve Gallo. I would say, great guy. But what I was curious about, Sasha and Mark, sorry, Phil.
Oh, yeah.
I recently insured two of my friends, Marshall and Anthony, for $100 million.
Wait a minute, you have friends?
I did.
Give me a minute to process that.
Marshall and Anthony, it's an interesting relationship nonetheless, $100 million. But premiums $100,000 a year, we purchased a grand. And my accountant, Michael Toner, is managing everything, and our attorneys, Richie, Mark, and Andrew, are trying to manage the entire process. The premiums, $200,000 a year. Any suggestions? So you look to get anything, given the new tax laws?
Well, the new tax laws aren't new tax laws.
Well, no.
The proposed changes to the tax law. So one of the things I suspect you are getting at in a very subtle manner is the proposed change dealing with split dollar financing.
Thank you so much for bringing that up.
Yes, I should have.
I was waiting forever.
I was hoping you were holding your breath. Yeah. One of the proposed changes that's kind of, and the insurance lobby could indeed be our client's best friend right now. They're advocating against the grantor trust provision. The question is whether they're going to only seek a carve out for ILITs. And if not, then we have to feel, how do we structure ILITs? We have to require that income cannot be used for the payment of premiums. We have to avoid 677. We have to make sure that there are no contributions. So it would have to be through loans or split dollar loan regime arrangements to try to navigate around these proposed changes. Split dollar is a phenomenal technique. It's still alive and well. And even in a family scenario, private form of split dollar, it doesn't have to be an employer-employee relationship. And that can be a way to finance the acquisition of insurance. Typically, we want to lock in the interest rate, which we're able to do under a split dollar plan and take advantage of our current low AFRs, which are also going up dramatically in November. They're still cheap, but going up, I think midterm from 0.91 to 1.04, something like that. So one of the proposed changes would be that that rate would have to be reset every year. And so as interest rates normalize, then it would become more expensive than if they were able to lock in, your clients able to lock in the rate for the loan regime, split dollar arrangement under today's rates. Mac, am I getting close to what you're saying?
You are so close. You can go to bed now.
I wish he was the one who said that. Okay. Don't get that on the streaming. And any other questions? So on behalf of Sasha, we thank you for your time and attention.